Good evening, tech traders. Today is the 24th of February, 2023, and I have got a new trade for you today. It is a trade that I put on earlier today. So I'm here after hours, 8:30 p.m. on the East Coast. I still think the analysis would be useful to walk through it, but as I said, I put this on this morning, and I put it on a company that I haven't traded all that much. What you're looking at on screen is the position or is the chart on Target stores. So Target is one of my favorite stores. My wife and I shop there frequently. We buy all the kids' back to school stuff. We're constantly going to Target, and we cannot seem to get out of that store without spending at least three figures worth of stuff. So Target is one of my favorite stores. I'm not a big trader in the retail space, consumer discretionary space, which is the sector that Target is in. But so why did it hit my radar today? It hit my radar today because of this right here, which is we have an earnings announcement coming up at the end of the month here, the 28th of February. We have an earnings announcement coming out for Target, and that is reflecting here in a tick up in volatility. As you know, anytime I see a tick up in volatility, I wonder if it is warranted or if there's justifiable or if there's what they call variance premium in this raise in volatility. In other words, is there too much fear out there which is going to raise the price of options, and it might be an opportunity to sell them. But we can't always assume that. We have to do our homework, and that's what I was hoping to do. And but this was the first thing that sort of caught my eyes. Oh, okay, I see a big spike in volatility leading up to what will be an earnings event. Then I also began to look at the chart. When you pull up the chart, and you can see that there was a really bad day here for Target back here in May. This was a really big drop in May, so they took a pounding back then, and I can't remember exactly what it was, but it was certainly related to earnings, and that brought the share price down, and it sort of has chugged along a little bit. And then in recent times, you've seen that it swing back up and get a little bit of a bid underneath it here, to the point where this actually made the news. What I'm highlighting right here, what I'm circling right here, is that golden cross. Chart technicians look at this, and they pay attention to it, and there's a lot of hope that this is a bullish signal for Target, that this pain that they experienced back then may be over, and maybe they're going to start on a better path, and they're going to grow. So I'm not a chart technician. I don't necessarily put a lot of faith in golden crosses or any other technical formation. I let the numbers speak for themselves, but I am aware that other people will look at this as a bullish sign for Target, and for that reason, maybe it's not the end of the world if we wind up with a bullish position. So we're going to put this onto the software package and see what we can find out. So let's first take a quick look at TGT, and we'll plug that in, and you can see that Devos will populate the fundamentals, and I'm seeing all green over here, leading, which is just confirming that we are in still a bullish environment. We've got a fairly low VIX, 21, which is pretty close to the historical averages. The VVIX, or the volatility of the volatility, is at 85, not expressing a lot of fear out there. The skew is reasonably depressed. Or let's just say that it's not elevated. And the VIX term structure is in contango, so that is also bullish for stocks. It's a little flatter than it has been in the past, so maybe things are changing a little bit, but it's still very much a bullish indication for stocks. And we are trading above both the 50-day moving average and the 200-day moving average for Target. So all these lead me to believe we could be in for we could have a bit of a bullish bias on Target, and that would be confirmed right here. What can I see about the historic volatility? Historically, in the 10-day period and 30-day period, it hasn't. It's sort of stagnated. The annual volatility for Target is in the 40s. So it's an active mover. It can move around a little bit with a 48% annual historic volatility. The one thing that does pop out on the screen as a red is the coefficient of variation, which means that you can be subject to some pretty wide moves, some pretty strong moves. It's this coefficient of variation is an indicator of volatility, and when it gets above 20, it's not completely immune from pretty significant moves. So when I see that, I think about buying myself a little bit more distance outside of that first standard deviation, for example. So let's keep an eye on that, and where we've been warned that this thing can move around a little bit. So let's see. So the trading months that I'm going to look at. Well, first of all, let's look at the intrinsic value calculation. In Devos, it's suggesting that it's $180 stock, $183 stock is a fair value. If I go to the fundamentals in Thinkorswim, I'm going to find that this thing is traded as high as 261 in the past 5-7 years. It's currently trading at 165, and it's had a low somewhere 75. 66 was the low since January of 2018. And if I look at the Trefis price here, they do carry some debt, the $12 billion worth of debt, but the target U.S. accounts for $87.7 billion business. I think it's in pretty decent shape. The Trefis estimate is $155 a share, so even more conservative than what we have in Devos. So 155, I'm going to go with the low between those two and say that I might be interested in buying some around $155 a share. The pundits out there, the analysts, all have some of them have a buy recommendation or a long recommendation, while others have a hold. That's kind of how I'm thinking about it as well, as I'd be interested in buying if I could get this thing a little bit lower. Again, I like Target, and I don't have a lot of exposure to the retail sector in my portfolio. So if we got a huge move down in Target, I'd probably be interested in buying some. So let's see what we can analyze from that standpoint. So what are we going to trade here? I'm going to trade the April 21st contracts. So let's go to the April 21st contracts. And I think they trade in, yes, $5 widths here. So with Devos, we start both the calls and the puts with one strike either at the money or in the money. So on the call side, I'm going to start with the 165 calls, and I'm going to build up from there. 165, 170, 175, 180, 185, and 190. That will analyze the delta range of 20 delta to about 57 delta. And you can see the beginnings of our volatility smile on the call surface diagram. Now let's do a similar range on the put side. I'm going to start here with the 165s, and I'm going to work my way down. So 160, 155, 150, 145, 140. Okay, so now I am looking at the delta range of about 13 to 40. And you can see there now we have the full volatility smile on the call surface. We've got significant put skew here. So we've got an 11.7% put skew. So that tells me that there is more risk to the downside on Target. So let's keep that in mind. Now, interesting here, the front month IV, when I look at this, when I put all of my option contracts in here, the front month IV of the combined option series is 40% in terms of the estimated volatility of the shares. Historically, target trades around 48%. So we actually have a bit of a depressed implied volatility here. So I'm not sure that there is necessarily an edge in playing both sides of the field. If you look at the puts, the puts are trading, the at the money puts are trading at 38 and 39, right here, $40 a share, 40 percent IV. That's below the historical average. So that's telling me if I'm going to find any edge in a volatility crush that I might play for here, so I'm playing for some sort of volatility crush here. You can see it, all the earnings announcements back here. We've had good volatility crush afterwards. I'm expecting that we're going to have that same volatility crush here, but the implied volatility for the puts near or just slightly out of the money is below the historical average. So there's not a tremendous amount of fear. In fact, you're going to have to go further out of the money to get a volatility, implied volatility, higher than the historical average. So you know what? I'm going to bring down these puts a little bit, and I'm going to start analyzing it a little bit lower. I'm going to start analyzing this at 155 and bring it down from there. So 150, 145, 140, 135, and 130. So now I've got a delta range here, and I'm still with a volatility that is quite low. So let's go even further. Let's go and start analyzing 140 all the way down. 135, 130, 125, 120, 115. Okay, now I've got the delta range that is delta 2 to delta 13. And now we're starting to see some of those 50% IVs, those IVs that are up here, that are higher than the historical, and those are the ones that might carry some more interesting premium. Now, the air gets a little thinner down around here. The bid-ask spreads, now we're after market hours, but the bid-ask spreads widen out. The open interest dies out a little bit down here. It's still not that bad. You've got after hours, you've got 8 penny wide markets here. They were a little tighter than this morning, so they've widened up overnight. But these are going to be the implied volatility ranges, I should say, here down, that are going to be more interesting to me. So the 125s and the 120s and all that. And you can see the IV on the calls are not really interesting at all from a selling premium standpoint. So let's go over to the trade builder. I think we're going to have to be well out of the money with our puts to find anything interesting here. We're going to set to be out of this trade like we normally do at least 2 weeks ahead of time. So let's pick April 7th, which would get us out of the trade 14 days ahead of expiration. We'd be in the trade for 42 days. I'm going to look and start looking at the 125 puts, which carry 75 cents premium using the mid prices, and the vol is elevated slightly at 49. So let's see what happens if we sell one of those. And you can see we get a very good, as you would expect, a very good probability of profit. There is a trade, there is expectancy in there. The payout ratios are good. The Greek ratios are very good. And the return on risk is good. The only thing that is a little bit difficult here is the return on capital. Again, this is a cash secured account. So if it's cash secured, that means you have to put up the full value of having to buy the puts if having to buy that price if they get put to you. So that's $12,000 in capital. So the return on capital is flashing red here. So how can I mitigate that? I can perhaps buy a 115 hedge on the thing, and if we were to do that, you can see I'm then now hurting my payout ratio here. It's no longer giving me the payout ratio that I'm looking for, and the return on capital is not quite there yet either. So let me see if I can bring this 125. I'll play around with this a little bit here, and now I've got if I do the 120 115s put spread, I do have positive expectancy. I've got a good pop. My payout ratio is there. I'm actually still struggling a little bit on the expected return on capital, although it's much better. Return on risk hits the target guidelines, and it's suggesting I could do maybe 20 times or 20 lot of this and still meet my risk reward criteria. So there is one thing I'm going to try to do, which is perhaps widen this out a little bit more, and I'm going to look at a 110 hedge instead of a 115. So I'm going to plug in 110 on this hedge, which is under a 2 delta on this, and let's see if that improves anything a little bit there. It improves my return on capital some, not tremendously. Gives me a pretty good, I would say pretty good return on capital at 1.2% for the time that I'm holding this. Maybe if I hold it for something a little bit less than 42 days, let's say if I was going to get out on the 31st of March. No, that doesn't really help my position. I got to let that develop a little bit more. It's actually better if I let it go to the 7th of April. So we'll keep that where it is. And at 1.2% return on capital, I think I could live with that. And it's suggesting here that I could take 12 times this position. So I'm going to look at what taking a 10 lot of this would look like. So doing a 10 lot would get me about $280 in premium. Very good expected value, good payout ratios, a good return on risk, and it looks appropriately sized here. So if I look at the Greek profile, you can see the sensitivity profile that I'd be having only a small amount of positive deltas. I'm okay with that. But you would really be playing the leading Greek in this position would be your short Vega position, which would be about 24 short negative Vegas. So that is really playing for this volatility crush that you're expecting to see after this earnings announcement. And you can see down here, I put on this trade earlier today. It is well outside of the volume bandings. It is well outside. It's almost close to the second standard deviation out here. I mentioned earlier that I wanted a little bit more buffer because of this value here. This coefficient of variation was flashing red at me. So it's saying, hey, be careful for outsized moves. So what I would normally do in that position is I would push the position a little further away from that first standard deviation, leading more towards the second standard deviation, which is what I've done here. I like the metrics, a very high probability trade. Quite honestly, if this stock does get down and it really tanks to this level down here, it would be the second big tank on Target. And in general, I think Target, if you look at the dividend performance of Target, it is a dividend aristocrat, meaning that it is a pretty confident that they don't cut the dividend. And if you look at the price of the price history, this is a 10-year chart charted against the dividends that they pay. You can see that this constant step up, this constant increase in dividend is what makes them a dividend aristocrat. They're constantly increasing and not cutting their dividend over a period of time. And then the price moves around relative to that. When this target shares got up around this price, $268 a share, was the high over the past 10 years. You can see this rocket ship upwards. I had no interest in acquiring Target up around there. But after that major move down that we had here, you can see it's kind of stagnated around here, but the dividend has continued to go up. So the price of the shares relative to the dividend they pay is actually looking quite favorable. In fact, if I can get these shares down around here where I've placed this trade at 120, you can see that is actually getting them at a very high dividend rate. If I can buy much below this blue line, that is compared to the dividend that they pay, and assuming they're going to continue to pay that dividend, that would be a very good acquisition price. The other thing that makes this a very good acquisition price is if you look at this breakout, this massive price breakout that we had back here in August of 20. Retail traders don't do this. Retail traders are not the ones that drive this massive explosion in price. This is institutional traders. There's no way it's anything but institutional traders that are going to take that price from 146 up to 268 in that short period of time. So you could say that this is sort of a buy marker right around here where a tremendous amount of institutional traders got behind Target at somewhere around $140 a share. If I'm placing my short puts down here around $120 a share, and it actually gets to that point, unless something drastically changed with Target, that's a pretty good buy zone. I'm looking at that as a very, very good buy zone. So let's go back to Tech 1 chart. We'll finish up our analysis here. So if we finish up our analysis with Target, I've got this short put spread. I'm not going to deal with anything to do with the calls, selling calls up here. First of all, I don't own any shares. There's really not going to be any value in me selling much on the upside of this stock. This is a bullish position. We've got a lot of reasons to be bullish, and if you look at our analysis of this, we've got a very, very good analysis, which is showing a strong Vega position, a strong short Vega position. We know the volatility is going to crush out of these shares in a couple of days. That volatility crush is going to come right here, and I think we're very well insulated from a strong move to the downside, being down here close to the second standard deviation. So a very nice probability of profit, almost a 90% probability of profit. On top of that, it has trade expectancy. It has expected value. So a good amount of expected value and a payout ratio, 143% of target payout ratio. And sorry, no pun intended for target. Good return on risk. I'd say an acceptable return on capital, something over 1% is an acceptable. It's flashing a little bit red here. In other words, Devos, the targets we put in there, it wants a little bit more, but that's not a bad return on capital for the period of time that I plan on holding this. Quite honestly, there's a good chance I'll be out of this after earnings in 4 days and not be holding this for 40 days. And if that's the case, and I hit my profit targets, my return on capital is going to be a heck of a lot better than 1.2%. It is sized appropriately with a 10 lot, sized appropriately for the risk exposed, and looking at Kelly criterion in terms of what I'm exposing to my portfolio. I'm going to need to post a little under $10,000 in capital from my account while this trade plays out. But overall, I like the short Vega on this trade, and I think I'm very well insulated from a super strong move. If that super strong move does happen, you can look for me to perhaps buy some shares here and make some other adjustments. I might not buy 1,000 shares of Target, but I will certainly be buying some, and I can make some adjustments on the other ones. But I think that's a good trade. It's a safe trade, and it meets all of the criteria that we've programmed into our software. So I put that trade on earlier today. You can see here I got about 200 and actually this is only a 5 lot here, and I put on and I got $255 worth of credit. So I actually, this morning, Target's price was a lot lower. They wound up finishing up on the day. So I actually got a very good deal on a 5 lot down here. So very happy with that trade. We will monitor this through earnings. I will check back with you after earnings, and we'll see how it does. Slightly bullish here. One of the best things that could happen is if we get some good news on Target, vol crush, price goes up, so we'd have positive delta move, we'd have a short vega move, which would put this position into profit immediately. So that is the best thing that can happen to us. We'll be prepared for the worst thing, which would be a huge down move like we experienced right here. That could happen. We'll be prepared if that does happen. But that's the trade for today. Hope you found this helpful. Best of luck with the trades. We'll check in with you again after earnings on Target. Have yourselves a good night.